Well, Happy New Year, everyone. Welcome to our High Rock monthly video. I'm Scott Tomlinson, and I am joined today by my partners Paul Tepsich, the founder of High Rock, and Bianca Tomlinson, High Rock's certified financial planning professional. Well, Paul, 2019 is behind us. It was a pretty good year for stock and bond markets, but when you take it into consideration with what happened in the last quarter of 2018, it actually brings things back into somewhat of a better perspective. Not quite as much strength when you take that into consideration. Certainly, our portfolios all did benefit over the course of the year, and thank goodness we didn't own any preferred share ETFs because that was one thing that stood out that really didn't do very well over the course of the year. Any comment on the preferred share world?
Yeah, for sure. We did own a couple. Now, preferred shares are bifurcated effectively between what are called rate resets, which effectively have a floating coupon that floats. Most of them float over a 5-year period. So when interest rates go down, that coupon gets reset at a lower rate, and that's what has really spooked the preferred share market in Canada over the last couple of years. And these are extremely complex securities to invest in. We have a very elaborate Excel macro that values preferred shares, certainly these rate reset floating preferred shares. So we've had a couple really good trades in positions and investments in both fixed rate preferred shares and rate reset preferred shares. At this stage, and through the past year, Scott, we've, as you know, have had very little exposure to preferred shares. We, quite frankly, for the bulk of the year, have only owned 2 or 3 at any given time, and in a very measured way. So they are very complex. The other thing I would say on this chart too, Scott, is and our clients will read this in our quarterly letter, but really you can see the XBB bond ETF versus the S&P 500, the performance being so positive on both for the year is really not how a balanced portfolio is supposed to behave. You know, bonds are not supposed to go up in lockstep with stocks, and quite frankly, that's almost what happened over the course of the year. So really an odd situation. I don't know what your thoughts are on that, but that's not supposed to happen. They're not supposed to go up together. One goes up, the other should go down, and vice versa. That's what a balanced portfolio should look like.
In the end, over longer periods of time, we know that will probably reverse itself to a degree. But again, it's often a combination of what we do own and, of course, what we don't own that will impact the portfolio. And I think your expertise in determining whether preferred shares make sense in the portfolio at any given time certainly has been a benefit, because we've had very little exposure to preferred shares while they have been in this, or especially the rate resets, while they have been in this free fall. But I know of some portfolios out there, at different places, where they have 15 to 20% of this preferred share ETF. So that's probably been pulling those portfolios back. Anyway.
Well, sometimes I run that Excel macro at least monthly, at the end of every month, on the wheelhouse of about 15 preferred shares that we look at. And in fact, right now, one modeled out extremely cheaply that we've already started buying, and we'll look to add to that as we get chances to get it cheaper. But it's pretty cheap as it is.
Yeah.
So yeah, we're on top of the preferred share market for sure.
Excellent. We do monitor benchmarks that we measure our performance by, and the benchmarks that we do monitor and the percentage weightings that we look at returned in 2019 returned close to 16%. But again, if you include the negative year of 2018, that the actual 2-year performance is significantly reduced. And again, this would also be impacted, or client portfolios would be impacted by our holdings of U.S. dollars and U.S. dollar assets, and that's not taken into consideration in these benchmarks, right?
No, it's not. And the currency, most of our clients have on average about 20% in U.S. dollar assets, whether it's in cash, cash equivalents, or various securities. And that would have cost somewhere around 0.6% across the year.
Right. And
the Canadian dollar improved, the U.S. dollar weakened. And a lot of that, quite frankly, happened in literally the last day of the year, December 31st, which was kind of painful to watch as the Canadian dollar rallied. And I think I think we'll talk about the Canadian dollar a bit further on, Scott.
Yeah, we will. And again, too, looking at this graph here, or this table, there's no fee considerations taken in here as well. So just for people's edification, that's the case there. But as we always manage risk first, and our longest standing clients have had the benefit of excellent risk-adjusted after fee returns over time, and that's we can see the red circled areas with a return per unit of risk better than the benchmark 60/40 portfolio, again without fee considerations on the far right. But interestingly, on a return per unit of risk basis, better than the S&P 500 over the last 7.25 years, which not significantly better, but still slightly better. And that's been a pretty high flying, but very potentially volatile asset class. So that's just something that we monitor on a quarterly basis. Any comments here from you, Paul?
Well, this is our ultimate goal. It's over multiple periods that we can outperform on a risk-adjusted basis against, for sure, our benchmark, which, as you said, is at the far right end of the table, the 60/40. But we can't always. We're not 100% invested in stocks, so we can't really compete with the S&P 500 or the TSX on a nominal outright basis. But what we do want to compete against them is on a risk-adjusted basis. And why that is so important to us and should be to our clients is because we want to dampen volatility of returns in our portfolios over long periods of time. Because having big losses, or what are called drawdowns, over a specific period, whether it's quarter, 2 quarters, a year, and go back, we quite frankly haven't seen a really big drawdown since the credit crisis over 10 years ago. Those are really hard to make up, depending on where you are in the life cycle. So this is our goal, our ultimate goal.
And it helps, certainly, as you said, in the long term, and as we focus on people's wealth forecasts and their cash flow needs and things in the future, and their goals in the future, this becomes a lot more significant. Well, 2020 brings a new decade. High Rock turns 10, and our private client division is going to turn 5 this year, which means that both Paul and Bianca have had to put up with me for the last 5 years, and for that, I do thank them.
And vice versa.
But what keeps us up at night, Paul? Well, let's talk about our outlook for 2020.
Yeah. There are quite a few bullets that we're going to whip through here very quickly, and some of them we've written about in blogs, both you and I. So the first one is the New York Fed's probability of recession indicator. This is their own study that they use, their own model. It hit 80% in August and has since receded a bit from that because a lot of it is based on the shape of the yield curve. But every time it's hit 80%, we've had a recession 100% of the time the next 12 months. So that's our number one concern here. Number two follows suit is the shape of the yield curve. And for those of our clients and listeners who do listen to financial news, the yield curve did flatten out substantially and kind of bottomed out in August. And then as it started steepening again in the fall, all the market pundits on the TV and radio news you would listen to were like, oh, we've averted a recession. That's not quite true. Historically, this is exactly what happens, is the yield curve flattens. Sometimes it goes inverted, sometimes it doesn't, but it starts steepening again. So that doesn't actually tell us we're not going to have a recession. In fact, quite the opposite. Historically, it does steepen again, and that's exactly what we've been doing the past 6 months. This is kind of tricky, and Scott, you show a lot of this, and I think you will again in this deck, but earnings per share estimates are really coming from Wall Street analysts. And they are, these guys do the work, but they also are very conflicted. Wall Street makes a lot more money being bullish than they do bearish. So as you can see here, on the S&P 500, the earnings per share estimates started out 2019 at 11.8% growth rate, but they ended in December 2019 at a minus 1.4% decline rate. Yet, as we all know, the stock market skyrocketed. And why did it skyrocket? Well, because these same analysts put what's called PE multiples on all these stocks. And they quite simply put their thumb in the air and just say, well, that stock was trading at a 20 times multiple, things look good, I'm going to move it to a 25 times multiple. And on that front, and I'm going to just recite, we probably could have put this in there, but I've actually looked at a few, if you bear with me, three well-known names, and I'll just tell you where they're trading. Their PE multiples are well above the market, in fact, even. But McDonald's is trading, all three of them, McDonald's, Procter & Gamble, and Johnson & Johnson are all trading roughly 23 to 25, 26 times PE multiple. That is really unheard of. And they've been that way for a couple of years now. They've just had enormous multiple expansion as the analysts have just ramped it up. Now, if financials don't follow suit, this becomes problematic.
And we'll talk a little bit more about earnings as we move through the presentation, just to show a few charts and things that will.
Yeah, we'll see that in a few minutes. Price to sales is another multiple that quite often Wall Street analysts don't necessarily peg, but it's interesting to look at. And again, we don't have a chart, but we can tell you that the price to sales in the S&P 500 is an all-time high at 2.3 times. And that's where it was during the dot-com bubble. And I remember those days, Scott, I'm sure you do, back in the late 90s and in the 2000, looking at all these stocks on price to sales ratio, and it was shocking. It's like, wow, the companies have no cash flow. So you had to look at it on a price to top line revenue or sales perspective. And it's shocking right now.
Well, I can tell you that my experience was that I started at the very beginning of my wealth management part of my career at the beginning of 2000, the end of 99, the beginning of 2000. So my education in equity markets was this unbelievable overpricing that corrected very significantly. And because I didn't really know equities and I only knew bonds, my first clients were fortunate that I just didn't want to get involved in something I didn't really understand. And I put them mostly into the bond market to start with. And that turned out actually to be pretty good. But sometimes it's better to be lucky than smart, I guess.
This is another concern of ours for sure, is the amount of structural debt in the world. Corporate debt to GDP, it's an all-time high, and higher, in fact, than it was during the credit crisis. A lot of debt is coming through these investment grade issuers who have bought back. They effectively raised debt to buy back stock, and that's gone through a lot of these companies. Like Apple has been a big one. They've issued a lot of debt, and again, I don't have the charter data necessarily, but I can also tell you anecdotally that investment grade issuers, their leverage or debt to cash flow is significantly higher than it was, and kind of some of them bordering on being more high yield issuers than investment grade. But the fact of the matter is that the overall amount of debt in the world is able to produce less economic growth than it used to be, because we are required to service that debt. And finally, this is kind of an interesting stat. We've known about this for past 6 months or so, but his position has grown. Warren Buffett's Berkshire Hathaway, which is effectively his holding company, is sitting on records amount of cash. They're at 128 billion right now. 2 years ago, they were at 24 billion. And people may hear or read about this cash pile that he's sitting on. He hasn't done a major acquisition for quite some time. And, the obvious conclusion here is that, Warren Buffett is not sitting on a pile of cash because he thinks the stock market is cheap. So here's an extreme, probably arguably the longest or most successful value investor of our time, who's sitting on records amount of cash. It just makes you stop and pause and wonder why, and then think, wow, what's he going to do? What's he waiting for? Well, a lot of his quotes are, you effectively sell when others are getting greedy and buy when others are getting fearful. And I think that's probably what he's doing. And I would also add on that last bullet that Berkshire Hathaway's stock, even though he's sitting in effectively almost 100% equity portfolio, his stock was only up about 11% last year in 2019. So seriously underperformed the S&P 500, which was up around 31%, which he has done before for sure. But sitting on large amounts of cash was extremely defensive for his position, and there was certainly a lag in performance.
So Paul, just to put this in a little bit of context, let's look at what's been happening with the S&P 500, and let's look at corporate profits, the green line here, and let's look at what U.S. GDP has been doing, and it here's some perspective again in a chart form, but it does really certainly show that the S&P 500 has come from a place where it was relatively good value back before 2014, but subsequent to 2014, the value has obviously slipped away. And I guess
we could probably even strip out the blue line and nominal GDP, because that's a macroeconomic stat. But the S&P, we'll go back to this multiple expansion. So just look at the green line, corporate profits since 2012. They've effectively flatlined. Yet since 2016, you can see the S&P 500 has taken off like kind of looks like a hockey stick. And why is that? Multiple expansion. Analysts on Wall Street just saying, well, I think that company is worth more. So to me, that looks like a mouth of a dragon opening up, and that doesn't represent value to me, because ultimately stocks and bonds, corporate bonds, are based on cash flow, not multiple expansion.
And we talked about earnings before, and analysts have continued to lower their and revise their expectations right through 2020. So even though I'm showing here that the fourth quarter, which we'll start to see results soon, and the first quarter have been lowered right through the whole of 2020. Estimates have been revised lower, and that you can see through this chart here, where earnings are just going sideways, and that's a 12-month forward-looking or look at earnings. And the S&P 500, of course, is continuing to rise. So, and looking at that as you were talking about before, as a PE or price to earnings ratio, you can see again we're getting almost as expensive as we got at the beginning of 2018, and we all know what happened at the beginning of 2018. In fact, right through 2018 when prices came down, and there was a very brief moment where there was value represented, and we tried to get some in. We didn't get as much as we wanted to get in, but still, we believe that being patient and waiting for these moments of value will benefit our clients in the long term, right?
And you know what? I just thought of something. I think when I first started working with you in 1990, I think you told me this quote: sometimes you don't know what the event's going to be. No one knows what the event's going to be, otherwise it would happen. Like, you just don't know. But when you see a market that is stretched too much, it doesn't matter what the event's going to be. Something will knock this back down into the value territory from the expensive territory. And we obviously are sitting on some levels of cash and cash equivalents that we are going to be able to buy. But boy, yeah, that sure was a V-shaped recovery in the latter part of 2018. That was extremely short-lived and fast.
Yeah, and I put it in the perspective of, or just the metaphor of an elastic band that's been stretched too far. What happens when you let go? Well, it snaps back, right? A lot, and it hurts.
Sometimes it hurts, I was going to say.
And you talked about greed and fear and Warren Buffett's theories about when to buy and when not. And of course, currently we're sitting at extremely high levels of greed in the Fear and Greed Index that's put out by CNN. When you look at a year ago, this index actually at the end of 2018 got down to somewhere near 2 or 3. A year ago now, or January 8th, a year ago was at 24, but still at an extreme fear level. And of course, you look at it and you see where those levels of opportunity come. And again, you brought up the Warren Buffett thesis of buying when everybody else is selling. And that's certainly when we think opportunity will arise, and we'll look to take advantage of that opportunity when it happens.
Well, Warren Buffett, in fact, doesn't even appear to be buying the dips because his cash position is growing every quarter he files. So it's kind of that's also kind of interesting.
Well, you'll notice here that you get maybe 2 or 3 of these opportunities, or 1 or 2 of these opportunities in a year, and you have to you have to be aware. Of course, we don't spend everything, but we will look at adding when these opportunities do arise. We're also concerned a little bit about the misperception of liquidity in the system. That is the one excuse that a lot of the market commentators will say that recently, because the Fed stopped tightening and actually started easing again, that this has been adding liquidity to the system. But we can see that since the Fed started tightening in 2015, after they ended quantitative easing, that the monetary base really hasn't grown considerably as much as it had shrunk. And so, again, there's that dragon's jaw, whereas these lines, the S&P 500 was very correlated before 2016. And once again, the events of through 2016 have, a lot of them have had to do with the election of Donald Trump as president, and a lot of them have to do with the promises that he continues to make that it would appear are being are not necessary deliverables. And I think in time, that's probably going to be what comes to hurt the market a little bit. And of course, we're focused on economic growth, which continues to slow on a global scale. And we follow leading indicators, one of which is business confidence, and it continues to point to further slowing in U.S. economic growth. The same thing in the euro area, same thing in Japan, in China. We've seen some stabilizing of business confidence, but Again, that may lead to some stabilizing of the economy, but we still are going to have a significant lag between whatever is in this phase one policy or phase one trade policy deal that China and the U.S. have made. Nobody even knows what's in that yet. There's lots of hope, but again, we've seen that you can't live on hope necessarily, and we'll keep an eye on it, of course, closely. And then, of course, Canada. Business confidence in Canada is pretty erratic, but it is trending down, and that will obviously pull the Canadian economy lower. And I think, Paul, we'll talk about that a bit more as we talk a little bit more about what is going on with the Bank of Canada. Perhaps the Bank of Canada reluctant to lower interest rates. Certainly, once they started to raise interest rates, as you can see on the right-hand side of this chart, that started to pull the Canadian economy lower. The Bank of Canada, again, fearful of provoking more binging on debt by lowering interest rates. So they're kind of stuck between a rock and a hard place. Any comment there?
Yeah, that's an interesting one, because with regards to the Bank of Canada setting the overnight rate, which is in black on this chart, they became an outlier. With you can see on the far right, we sort of flatlined. Meanwhile, the U.S. Federal Reserve Board, the U.S. central bank, cut rates, I think 3 times, if I'm not mistaken, Scott. Regardless, they were going in the opposite direction, and Canada came out sort of talking. The Bank of Canada came out talking kind of tough that no, we don't need to raise or cut rates. Our economy is pretty strong, and I think a lot of that was just jawboning the consumer to stop, as you said, binging on debt, because our debt to disposable income is off the charts in Canada. So our consumer is in a very precarious position. We could not afford to see rates go higher, but I don't think the bank wanted to cut rates and encourage yet more borrowing. So this has left the bank in a rock and a hard place, because what happened over the past few months is the Canadian dollar improved because the bank wasn't cutting rates. And quite simply, the reason for that being, well, if rates in Canada are going to stay a little bit higher, then global money could put money into the Canadian dollar and Canadian rates and make more, have a higher yield on their money. So that was problematic because the Canadian dollar improved, and when the Canadian dollar improves, it hurts exports because it makes them more expensive. So the bank was, or still is, caught between a rock and a hard place with regards to the currency and rates. And I do, Scott, just one anecdotal thing here on the Canadian economy and where rates are, and the Canadian dollar for that matter. I've been doing a fair bit of research on the Canadian banking sector, and in particular looking at buying some of the stock of one bank, which has been hit down a bit. But all of our Canadian banks actually have sold off a little bit here from the highs, for sure. Quite simply, they reported their fourth quarter and fiscal year end of 2019 on October 31st. And one thing stood out amongst all others when I read those reports in November was what are called PCLs, Provision for Credit Losses. And they were up year over year at 37%. So all the Canadian banks collectively had to increase their provision for credit losses. So this is the amount that they have to effectively provide for in case these losses turn into, or in case their loans, turn into actual losses. Now the number itself may not be huge, but the delta from where they were a year ago to October 31st is quite big. And as I said, and all the reports kind of stood out, and the bank stock sold off a bit because of that. And that's got me a bit more concerned about the Canadian situation. So I'm not overly bullish on the Canadian economy, which means at some point the Bank of Canada is going to have to cut rates. And I think that will continue to weaken off the Canadian dollar, which has improved pretty dramatically over the past few months.
Well, let's look at the Canadian dollar here on this particular chart. And it's interesting because up until basically 2018, the Canadian dollar traded or tended to trade fairly in line with the general prices of oil. But that started to change somewhere in 2018, and as the Bank of Canada started tightening, as you were saying, the Canadian dollar started to improve because rates were going up, and international money started to flow into Canada to take advantage of slightly higher interest rates.
Well, the problem with this chart is, as you can see, there was a bit of a gap that opened up in 2018 between the Canadian dollar and the price of oil, because the price of oil that we're showing on this chart is West Texas Intermediate Oil, WTI. That's effectively U.S. oil out of Texas. Canada, we don't have West Texas Intermediate Oil. We have Canadian oil, and Canadian oil comes in both light and heavy oil is considered tar sands. But the differential between Western Canadian Sedimentary Oil, WCS, and West Texas Intermediate Oil, WTI, got out to about $45. Canadian oil was trading $45 underneath WTI. Now it's out around $18. So the problem goes back to which I'm sure we're all aware of, especially going through the Alberta election and the federal election. The problem is Canadian oil is trading extremely cheaply, and that is harming our economy and our currency at times here.
All right, thank you for that. Well, I guess there's plenty that keeps us up at night, Paul, but we stay up at night worrying so that our clients don't have to, and hopefully that helps them sleep better. But what we can get excited about, and something that has happened a little bit recently, is that we've had some new clients seek us out and join us. Some have been referred, which is great. We really appreciate that. Others have come over from people who I looked after in my previous life, have sought me out. That's been great too. So we're thrilled to welcome all our new clients on board. We're always happy to take introductions. If you know anyone who might benefit from our conservative approach, our somewhat contrarian style, and our solid service, we're always looking for introductions. Of course, we always keep everything focused on the long term, and we think that putting together these wealth forecasts is really a key to everybody's individual future success. The investing part becomes just a function and the structure of your goals, and the portfolio strategy follows that always.
I would probably add on that, Scott, on our wealth forecasting. This is really the basis for the amount of risk we take for each and every client. And we do not want to take any more risk than we need to take to meet these goals, because that's our ultimate goal, is meeting our financial goals, well, having our health, but being able to meet our financial goals into the future. And we don't want to speculate on markets and take undue risk when we don't need to. So we really just need to meet these goals over time.
Yeah, exactly. And we obviously share that philosophy, and that is, to a large degree, the underlying philosophy by which we founded our High Rock Private Client business. Now, speaking of wealth forecasting, Bianca sent out a reminder to all of our clients to think about their TFSA top-ups and RSP contributions. I know that we all have a little bit of time for RSP contributions, but March does creep up quickly. So if you need a wealth forecast review to determine your next steps, please let us know as soon as possible. You can guess who takes the brunt of Bianca's wrath when she's given lots of last minute business to look after. So that would be me. So I'm going to give everybody a bit of a push here to think about getting things done prior to the deadlines. Well, Happy New Year, everybody. Thanks for taking the time to tune in. We'll be back at the beginning of February with another edition. On behalf of Paul, Bianca, and myself, I wish you a wonderful January, and stay warm.